We're told the richest countries in the world are the generous ones. They send foreign aid, they forgive debts, they talk about development, stability, and helping poorer nations grow. But if that were really the whole story, why does wealth keep flowing in one direction? Why do the poorest countries in the world keep paying the richest year after year, crisis after crisis? Every year, billions of dollars leave developing nations not as charity, but as interest payments, fees, and profits. On paper, the rich are helping the poor. In reality, many of the poorest countries on Earth send more money out than they ever receive. The question isn't who's being generous. It's who built a system where helping you also means owning you. This is the ledger of power, where money, empires, and ordinary lives intersect. And in this story, nothing about aid is as simple as it looks, because global finance doesn't just move money, it moves control. Today, we're going to trace how the world's wealthiest nations quietly steer the poorest, not with armies or colonies, but with something far more elegant: contracts, ratings, and debt. For most of history, powerful countries controlled weaker ones with soldiers and flags. You conquered territory, raised your flag, and took what you wanted. But in the 20th century, something more sophisticated took over. Formal empires collapsed. Colonies became independent. Yet somehow, the flow of wealth didn't reverse. The tools simply changed. Instead of governors, you got advisors. Instead of tribute, you got loans. Instead of a colonial office, you got an IMF mission and a credit rating. The map said independent. The balance sheet told a different story. Imagine a new country after independence. It needs roads, ports, power plants. It doesn't have the savings to build them. So who steps in? Banks in London, New York, Paris, development agencies, export credit agencies. They offer loans for nation building, bridges, dams, railways, all financed with borrowed money, often from the very nations that once ruled those same lands. On paper, it's progress. In practice, it's a collateral chain. Because those loans don't come alone, they come tied to contracts. You must hire our companies. You must buy our equipment. You must accept our legal terms. The money appears in your country. But a huge slice of it immediately flows back out to the lender's corporations. The debt, however, stays where it is, on your books. As long as growth is strong, this system looks sustainable. Tourism rises, commodity prices are good, exports grow. Then something breaks. A global recession, a pandemic, a war, a currency shock. Suddenly, the country can't roll over its loans so easily. The interest payments, priced in dollars or euros, start to suffocate the budget. Hospitals or interest, schools or interest, subsidies or interest. And that's when the polite language disappears. Now the creditors start talking about fiscal discipline and reforms, not for themselves, for you. When a poor country can't pay, it doesn't usually default in a clean, dramatic explosion. It's more like slow suffocation. So international institutions arrive. The IMF, the World Bank, sometimes regional lenders. They offer new loans to pay off the old loans. But there's a price, always. To receive help, governments are told to cut subsidies for fuel and food, privatize state assets, open markets to foreign investors, freeze or cut public sector wages. It's presented as modernization. But the effect is brutally simple. The ordinary citizen pays through higher prices and lower services. The creditors are made whole. The rich countries' banks don't take the real hit. Your people do. We often say that democracy decides a nation's future, elections, parties, platforms. But in heavily indebted countries, there's another kind of vote, cast not in ballot boxes, but in bond markets. If investors don't like your policies, if rating agencies downgrade your credit, if big funds decide your bonds are too risky, your interest costs spike, your currency falls. Your people feel the pain. It doesn't matter who won the election. If the markets veto your government, your agenda shrinks overnight. Citizens pick parliaments. Creditors pick the limits of what those parliaments can do. There's an even more dangerous layer, borrowing in a currency you don't control. If you're the United States or Japan, you can borrow in your own money. In a crisis, your central bank can create more, not pain-free, but survivable. If you're a poorer country, you often borrow in dollars or euros. You don't print those. So when your currency falls, your debt doesn't just stay the same, it explodes. It's the same lesson repeated from Latin America in the 1980s to Asia in the 1990s to crisis after crisis today. Debt in someone else's money is not just a risk. It's a leash. And the hand holding that leash isn't yours. So if poor countries are drowning in loans, if their budgets are squeezed, if their economies are reshaped by conditions set abroad, who's on the winning side? It's not just one villain. It's an ecosystem. Big banks earning interest, corporations winning privatization deals, investors buying assets at crisis prices, rich country governments gaining leverage and diplomacy. Each insists they're just following markets. But together they form something larger, a machine that quietly channels value upward, from wage earners and taxpayers in poorer nations to balance sheets and portfolios in richer ones. The most effective control is the kind that doesn't look like control at all. There are no foreign flags flying over ministries, no imperial soldiers marching through streets. On paper, every country is sovereign. In practice, many live inside a narrow corridor of choices, lined on both sides by contracts they didn't fully design and risks they don't fully control. Raise wages too fast, investors leave, subsidize basic goods during a crisis, ratings fall, talk about default or restructuring. Your currency is punished before the speech is even over. You don't need a governor's palace or a viceroy when you have a system where the price of disobedience is economic collapse. If all of this sounds abstract, it shouldn't, because the same patterns that shape nations also shape individual lives. Households overloaded with debt, workers dependent on one employer, citizens holding all their savings in one fragile currency, inside one fragile bank. The same rule applies at every level. The more your fate depends on someone else's promises, the less control you truly have. That's why in every crisis, from Byzantium to Lebanon, the survivors tend to share three things: diversified assets, not just one kind of money, some cushion of savings, however small, skills that create value even when systems break. Those are the people who don't just endure shocks, they use them. The richest nations on earth don't have to invade to shape the world. They can do it through spreadsheets, contracts, and interest rates. Is every loan predatory? No. Is every institution evil? No. But the pattern is clear. Systems built in the image of rich nations tend to protect rich nations first. So the real question isn't just why poor countries are in debt. It's who designed a game where the poorest keep paying the most, even when the rules say they're free? And on a smaller scale, when the next crisis hits, and it will you be on the side that trusted the system completely, or the side that understood it well enough to avoid being its collateral? If this gave you a new way to see the world, hit subscribe. History doesn't just explain the past. It shows you who really holds the strings.